Essentially, what you do is you borrow in a currency with a low interest rate, and then you invest in the money market risk-free in a currency that has a higher interest rate. And so a common feature of these set of carry trades is they earn consistently small returns, but then are occasionally disrupted by major crashes. And so a common way to refer to FX carry trades, but also other broader carry trades, is that they're picking up nickels in front of a steamroller. It's quite worrying that even such small events can trigger such outsized moves. And so now imagine what could happen in an environment of such vulnerability when a big shock happens.
This raises some maybe questions about over-the-counter versus exchange-traded. Equity markets moves were much more violent than those in foreign exchange, despite sort of foreign exchange being at the core somehow.
Hello, my name is Andreas Schrimpf. I'm head of financial markets in the Monetary and Economic Department of the BIS.
And I'm Sushko, a senior economist for Bank for International Settlements.
And I'm Krista Hughes, speaking from Basel. You're listening to BISness, the podcast from the Bank for International Settlements. There was a sudden bout of market mayhem in early August, which pushed Japanese stocks down 12% in one day and pushed the main gauge of market volatility, the VIX, up to levels not seen since the early days of the pandemic. Commentators soon pointed to yen carry trades as the cause of the problem. But a new BIS bulletin says carry trades might be just a symptom of underlying market issues that could return at any time. With me to discuss the market episode and its implications are Andreas Schrimpf and Sushko, who've written extensively about markets and currencies. Thanks for coming on.
Thank you, Krista. It's a pleasure.
So, Andreas, can we start with you? Tell us, what is a carry trade?
That's indeed a good question, Krista, and we often see quite a bit of confusion out there in the commentary. So it's really good to basically just define what we're talking about. What we typically think of when we talk about carry trades is the variant that's implemented in the foreign exchange market. So essentially what you do is you borrow in a currency with a low interest rate. That could be, for example, the Japanese yen or at times also the Swiss franc. And then you invest in the money market risk-free in a currency that has a higher interest rate. So that could be, for example, the Mexican peso or the South African rand. Often you actually don't just implement that by actual borrowing and lending, but you rather do it in derivatives. So that's oftentimes the more easy way to implement these trades. And then there's a theory out there called uncovered interest parity. We all know it from our studies, undergraduate textbooks, that basically says that such a transaction should not give any profits because the exchange rate would wipe out this interest rate differential that you're trading on. But we also know that this basic theory really fails in practice. So the carry trade is actually a profitable trading strategy. And therefore, it's quite common. It comes and goes, but it's often used by hedge funds and other players who like that strategy from a risk-return perspective. And I should also say, as a side note, there are also several carry trades that are also implemented outside of the foreign exchange market that are relatively similar in terms of their profile. Similarly to the FX carry trade, they are centered around the earning of consistent small returns, use leverage, and are effectively a bet that volatility will remain contained. So this would be also often implemented in fixed income, in equities, and also even in crypto. And so a common feature of these set of carry trades is that, as I said, they earn consistently small returns, but then are occasionally disrupted by major crashes, and when we suddenly get a significant drawdown. And so a common way to refer to FX carry trades, but also other broader carry trades, is that they're picking up nickels in front of a steamroller.
And is that what happened in early August?
Yes, I think we've now been through many of very similar episodes in the past, and so the patterns that we saw in early August, they were really very much akin to some of those that we have seen before. In the past, there have been even bigger crashes. So what comes to mind is 1998, around the LTCM crisis. That was a major carry trade unwind that was happening. And during the GFC as well, in the particularly early phases, there was a major unwind of the yen carry trade at the time.
And what was the trigger for this particular episode?
Yeah, so there's typically a confluence of factors that we need to point to. When it comes to the actual catalyst for the event, one can say that it's been relatively minor. We had the Bank of Japan coming out with a relatively hawkish policy decision. And so also already that meant that interest rate differentials had been moving to some extent. At the same time, there was a labor market data release on August the 2nd, which was seen by many as a worrying sign that the U.S. economy might be in more trouble than what a soft landing would imply. So there was quite a bit of sentiment deterioration in this time, and that was the trigger. But then we have to think as well about why it was so vehement and quite forceful market reaction. And there it's important to keep in mind the environment in which this happened. So for quite some time, we've been through an episode where the Japanese yen was depreciating. Then we had volatility being very low, despite a lot of uncertainty also out there. We've been oftentimes been puzzled why the VIX was so low and volatility elsewhere. And also leverage was ample. So the puzzling thing was, to some degree, why financial conditions were so loose, even though we are still in a tightening mode. But exactly in these environments of low volatility, large divergence in monetary policy, this is exactly when carry trades are most attractive for investors. And so we saw that buildup of positioning, not just in FX, but across several related asset classes that are effectively short volatility positions. And then, with this increase in volatility, these trades had to be unwound.
And Vlad, what does that mean to say a carry trade has to be unwound?
In simple terms, it's basically to reverse the existing position by doing exactly the opposite of what you did when you put on the trade. For example, when exchange rate starts moving against you, you want to take whatever profits you can before they're wiped out. So that is, sell the high-yielding asset, exchange back the high-yielding currency for the low-yielding currency, such as the yen, and then repay your borrowing in the low-yielding currency like the yen. But what I just described, it's a fairly cumbersome way of unwinding a position and a cumbersome way of putting on a position. And as Andreas already mentioned, carry trades would largely put on using derivatives, such as forwards and futures. And these are effectively off-balance sheet instruments. In that case, you would just want to close your open position. In derivatives, you want to close your open short position in a low-yielding currency. You want to undo your open long position in a high-yielding currency with offsetting trades in forwards or even spot. But what is important about all these cases of unwinding of carry trades is that the unwinding itself, so everyone rushing to sell the high-yielding currency, buy back the yen, it only works to exacerbate the adverse exchange rate move. You can see already how this can generate like a self-reinforcing dynamics. And that's why episodes of carry trade unwindings tend to be quite violent. Well-known episodes, Andreas already mentioned, the LTCM crisis or the Great Financial Crisis. What we saw this summer was on a much smaller scale.
But that being said, there were still a lot of large figures being bandied about. Can you give us an idea of how large the carry trade is?
Yes, we think it's a hundreds of billions of dollars question, but the exact size is hard to estimate for a number of reasons. As already mentioned, there are a wide range of instruments that can be used to implement these trades, with the lion's share implemented using off-balance sheet derivatives, which are a much more opaque market segment. But at the same time, BIS data can help shed light on this. Based on our over-the-counter derivative statistics and the triennial survey turnover data, with some further assumptions, we think that a reasonable estimate for hedge funds' speculative activity in currency forwards, for example, is somewhere upwards of 150 billion. Note that this is a much higher number than one might get by looking at public data from currency futures, exchange-traded futures. which are most often used indicator of this activity because of data availability and some better information of who's behind the trades. But futures are just the tip of the iceberg. And also for the on-balance sheet activity related to carry trades, BIS banking statistics can offer a clue. From our global liquidity indicators, we think that a number in the vicinity of somewhere around 250 billion or 40 trillion yen provides a ballpark. But we still must stress that these numbers should be interpreted with care. They also provide a lower bound due to data gaps. For example, BIS work on hidden leverage using FX derivatives by Claudio Borio, Patrick Maguire, and others may be useful to revisit in this context. Is this a carry trade? Some may argue that it is. And so I would say I anticipate more analysis by BIS economists related to the size of carry trades and data gaps to be forthcoming in the future.
And you mentioned the people who are behind the carry trade. So who is Mrs Watanabe and where does she fit into this?
Mrs Watanabe is an archaic term, but it's used to describe the typical Japanese retail investor trading via margin retail broker accounts, particularly in the foreign exchange markets. So this term originated in Japan a long time ago and has kind of become a catchphrase, so everybody knows what we're talking about just for this shorthand. But it reflects a broader phenomenon of Japanese retail investors as a powerful and influential force in the global foreign exchange market and representing the collective behavior of millions of small-scale individuals who can nonetheless have effects on aggregate market trends. In the bulletin, we show that the trading volumes via Japanese retail margin accounts have ballooned since the pandemic. And they have mostly turned to being short the yen recently. So many would have been caught on the wrong side of the market on 5th August. And just more generally, since retail traders across all asset classes, they're offered very generous leverage by their margin brokers. They're very sensitive to the spikes in volatility and margin calls. And so they would be hit hard during such episodes. And also during the recent episodes, it looks like, for example, crypto was hit hard.
So the retail investors are having high leverage, so they're borrowing a lot to finance the trades, which makes them very, very badly impacted when things go awry.
Yes, they'll probably be the first in line.
The market's recovered quite quickly, but you point to some factors that amplified the sell-off. And what were they?
Exactly. So definitely the moves have been really outsized, I would say, compared to the trigger, and that means there were amplification effects. One certainly was the relatively low liquidity during this time period. We've often in the past had market calamities in the month of August. Basically liquidity is low. We have also less risk appetite, less staff on trading desks, and reduced risk budget for the traders that are at the desks. So that's one factor. But even more important, I would say, are these dynamics. So Vlad already alluded to them, that have to do with deleveraging pressures. So when you have a lot of leverage involved, like as is the case with these hedge fund positions, but the same is true for the retail investors on their margin brokerage accounts, when volatility increases, as did already somewhat during the course of July, actually, but then really in a big way early August, then margins tend to increase. So the investors need to put on more capital. There are calls for margin. And that means the positions need to be scaled down or assets need to be sold and liquidated to fulfill these margin calls. And so leverage needs to come down. And if this gets violent, it could even be a self-fulfilling spiral that continues for a while. And so, these were the factors that amplified the move, I would say.
So when there's a margin call, the investor has to put in more capital to cover their position, so they have to sell something else.
Absolutely. And maybe just then to add on to what I said, what has maybe been to some degree puzzling is why we've then seen these violent moves across asset classes. But one has to keep in mind that, let's say, if you're a multi-strategy hedge fund, there are different parts of that hedge fund that, one part could be investing in FX carry trades, another could be having various kinds of option strategies in the equity market at play. And when you then have, however, a VAR spike or a VAR constraint biting, these conditions need to come down for the entire hedge fund. And so you get even relatively unrelated assets that are on the surface not FX that see violent moves. Maybe also a telltale sign that retail investors got hit was the reaction of crypto in the height of the turmoil. So we saw Bitcoin and Ethereum prices really plunge in these hours when the yen spiked and large FX carry trades were unwound. And so, you could basically get the situation that whatever is then liquid and available to sell to meet the margin calls sees violent moves as well.
And what sort of lessons should we draw from this episode?
Yeah, so first of all, we have to basically say that we can take comfort with the plumbing, to actually have withstood the test of high volatility quite well. So margin was collected. We didn't also see much of intermediation being impaired. So that's the good part. But I think there are a few more worrying lessons and things we need to consider going forward. The first is it's quite worrying that even such small events can trigger such outsized moves. And so now imagine what could happen in an environment of such vulnerability when a big shock happens. But also more generally, we've now seen a replay of some of these deleveraging dynamics and pro-cyclicality in the financial system. And so the fact that we keep seeing these types of pro-cyclical deleveraging events over and over means that there's something more structural that probably we should address as a policymaker community and also as market participants.
And do you have anything in particular in mind there?
Yeah, so I would say there are a couple of things for sure that would have to be addressed. One is also, as Vlad has already mentioned, there are quite a few data gaps out there about the buildup of the leverage. Where is it used? Now, in the past, we used to get a very good view just by looking at the banks because they were at the core of intermediation. Now we have so-called non-bank financial intermediaries playing a much bigger role in the system, and there we have not a very good view into about the positions. We can only sometimes see the tip of the iceberg, really. So monitoring that buildup of leverage is going to be important. But then also making sure that these sparks that I mentioned before don't create these outsized market liquidity problems. And one way to address it is to think carefully again about the procyclicality of margins. So making sure that margins and also haircuts don't support such large buildup of positions in the calm phases. So by haircut, it basically means the amount of actual capital you need to put down to finance a position in the treasury market. We know that, for example, because of the very large safety of the asset, they can be razor thin, almost 0%, meaning that you can borrow virtually the same amount against when you pledge that asset as collateral. So because of razor thin margins that we get crowdedness of positions and a buildup of leverage. And then in the sort of also as the flip side, to avoid these big margin increases to then create disruptions and increases on the liquidity demand that would overwhelm the system and intermediation.
Can I maybe just chime in on the last point? This raises some maybe questions about over-the-counter versus exchange-traded. it's not a smoking gun, but equity markets moves were much more violent than those in foreign exchange, despite sort of foreign exchange being at the core somehow. And one is exchange traded, and there, of course, there's margins, haircuts. They're calculated quite differently than markets that rely on more bilateral interactions with broker dealers and bank credit.
Yeah, I agree. And here it would really be useful to do some further study as to the role of the market structure, all-to-all versus dealer, the dealer-centric market, but also CCP versus bilateral clearing. How have different market structures been weathering the shocks? So we can learn quite a bit from these episodes.
You can read more about this topic and more on our website, bis.org. Do subscribe to our podcast BISness on iTunes and Spotify, and follow the BIS on X, LinkedIn, YouTube, and Instagram.